Okay, now let's finish up talking about this bond example. In the previous lesson, the last thing we noted was that for a $100,000 bond issue, again, we are borrowing $100,000 by selling these bonds to bond investors. The price of the bond, or the amount we will receive, is $107,260, or $7,260 more than we must repay. Well, I think the first thing we need to do is show the entry to record our bond issue. The entry would include a debit to cash. We would increase cash for the amount, for the price of the bonds, $107,260, for the amount we will receive in cash. Our main bond liability, bonds payable, is credited for $100,000 because that's the amount that we will ultimately have to repay at the end of 4 years. And our balancing account is premium on bonds payable for $7,260. Now, how do we end up with a premium? How do we end up collecting $7,000 more than we have to repay? Well, if we go back to the facts of the example, our bonds pay 6%, and in this first part of the example, the market rate is assumed to be 4%. So what does that do to the attractiveness of our bonds relative to all the other bonds out there on the market? Our bonds pay 6. The average for bonds on similar bonds on the market is 4. Our bonds are more attractive. They pay a higher rate of interest and therefore command a higher price upon sale. We get a premium when we sell these bonds. And again, it's not an arbitrary calculation. It is based on the facts surrounding the bond issue. Our bonds pay 6%, market is 4%, and then we do the present value calculations that end up giving us a bond price of $7,260 more than the amount we are borrowing. How does this work over the next 4 years for us? Well, if we were to refer to page 470 in the text, supplement 10A, and I'm looking at straight line amortization of the bond premium. If you go down to near the bottom of the page where it shows the yellow table, notice that there over on the left side in column A, we have 4 payments of $6,000 each. And then in column B, it refers to amortized premium. Well, how we get the amortized premium? Using the straight line amortization method. We would take the total premium of $72.60 and the bond term of 4 years and do that calculation. And so if we take $72.60 divided by 4, that amount is $18.15. And so every year, along with the entry to record the payment of the $6,000 of interest, we would make a second entry to record the amortization of the bond premium. Let me illustrate how that works. when we make the interest payment, we would debit, remember, we are the borrower, and so we are making those interest payments to our lenders. And so our interest will be recorded as interest expense, and that amount would be $6,000. And of course, our credit for the payment would be to cash, also for $6,000. We also have to deal with our premium on the bond issue. And again, our premium is $7,260. Premium is a credit. It represents an amount in excess of the amount we have actually borrowed and need to repay. So we got more than we need to repay. Again, I've said that numerous times. And so using the straight line amortization method for the premium, we amortize $1,815 of that premium every year. So our entry to amortize the premium would be to debit the premium on bonds payable and credit, which account you think is going to be credited. If you think about this long enough, I think you'd figure it out. We will credit interest expense, and the amount of this entry is for $1,815. Again, using the straight line amortization method for the premium. And so if we were to look at these accounts in the accounting equation format, what would it look like? We have assets and expenses over on each end, and then we have liabilities, owner's equity, and revenues in the middle. And we are focused on liabilities, bonds payable, and we have $100,000 of bonds payable. And we also have our premium on bonds payable. And again, that amount is a credit, $7,260. And so when we make this entry for the first payment of interest, we will debit interest expense for $6,000. And then when we make the second entry to record the amortization of the bond premium, we will decrease bond premium by $1,815, and we will decrease our interest expense by a similar amount. We will make both of these entries 4 times over 4 years that the bonds are outstanding. So by collecting $7,260 more than we have to repay, the net effect for us is that instead of an expense of $6,000 a year, and again, if you refer to that table near the bottom of page 470, instead of a $6,000 expense every year for 4 years, we are effectively incurring an expense of $4,185 of interest. And the reason for the difference is the premium on those bonds. Now again, this is a long example. It's taken quite a while to get through. But this example is right out of the chapter. It's right out of the text. And so I hope that by presenting it here for you this way, it's a little bit easier to understand. And again, as with everything else that I presented here or prior to this, or moving forward into future chapters, if you have specific questions about this material, you can email me anytime and we can discuss it further. Thank you very much. And our next lessons will be on chapter 11.